Hello there and welcome to your CIMA February 2018 Management Case Study. I am Kate Williams. Some of you may have already received emails from me or referencing me in emails that you've received, or you may have been taught by me maybe at P1 or P2. So lovely to have you on board. So my email address for you first of all, guys, is kate.williams@httpartnership.co.uk, and I am your management case study lead. And the reason that I'm the lead is that I deal with, as I just said, the P2 paper. Okay, and so the P2 paper is the lead paper on your management case study exam. In addition then, guys, you will not just be having myself as a tutor for this level, you will also have a tutor for E2 and also for F2. So your E2 tutor is going to be the fabulous David Heath. And so if you wanted to contact him, david.heath@httpartnership.co.uk. And then for F2, we have the fabulous Jodie Lucas. Okay, so Jodie, again, at the same email address there in that sense. Also, you can have my contact number as well. So it's 07940 268822. So if you did need to speak to me for any reason, or text me or WhatsApp me, you can of course do that as well, and I'm there available to you. We want you to feel fully supported on your management case study journey. Okay, so obviously we'll get to know each other more as we have our live sessions together, but what we're going to do in the next probably 40 to 60 minutes is have an overview of the case study that we have for February 2018. So I'm not going to try and teach to you guys in this hour. We're simply going to have a look through the case study from a P2 point of view, and it's the kind of thing that you need to do on a daily basis for the next few weeks, looking at your case with your different hats on, P2, E2 and F2. And obviously 99% of students are familiar with doing this at this level because you will have sat your operational case study exam. So most of you will have that knowledge, but some of you may either be new to this in terms of you used to be on old style syllabus and therefore completed operational level before 2015, or you may be a gateway student, in which case you won't have sat your operational case. And also you might be thinking, what are the references to P2, E2 and F2? So if you are a gateway student and any of the terminology isn't quite common sense to you, or you're not really familiar with it, then just drop us an email. We can give you a bit more explanation. But basically the pillars are made up of your performance management style paper, your economic style paper and your financial accounting style paper. And when we look at the case, we're bringing all three of those together. Okay, so we'll go through this case study from this P2 overview, as I said, and then obviously when we have our sessions together, we'll look at this in a lot more detail. Okay, so this is a bit of a whistle-stop tour. And what I'm aiming to do here is kind of recap some of the P2 syllabus areas that you were examined on and that you may be examined on again from a case point of view. So it kind of gets those alarm bells ringing and think, oh my goodness, I can't remember anything about that area. Or you think, oh yeah, okay, I still feel quite confident on that area, depending on how long ago you sat that particular paper. So your case study then, guys, is a company called Norton. Okay, and when we go into the case study, actually, it obviously initially talks about a fuel station, an oil industry. Now, in terms of the case study itself, we've got around, I think it's 20 pages in total, 19, 20 pages. So we have got to get familiar with all of those pages, but obviously we're not going to go through every word here today. So you are, as we just said, a major quoted oil company. So you are quoted, so already thinking about your F2 syllabus. You operate globally, so thinking again about your strategy or maybe your risks. You are a global company. Most of the accounting information is processed at Norton's Finance Operations Shared Service Centre, FOSCC, and it's this shared service centre that really seems to drive the focus of this case. So rather than it being about the oil company, it actually seems to be more focused on the shared service centre. However, at no point can we then say, oh, well, it's not going to be anything to do with the oil company, because that would be a bit crazy to kind of have that thought process in there, because the when we look at the structure, you'll see that there are so many ways that they could examine this from not just P2 but E2 and F2. So we've got to try and keep a very open mind on this one, guys, on as to where they're going to focus your variant. You are a senior financial manager, so that's important. You're no longer, a data entry clerk or just simply processing the month end. You are a senior financial manager. We are there to advise the business, and we are based in the head office in Centaria, where the shared service was established in 2002. The currency is the C dollar, so it's important that you know who we are, who we're working for, where we're based, what the C dollar element is, because we want to make as many references in the case as we can. Your primary responsibilities are associated with management accounting, which means you must often liaise with colleagues in many of the countries where Norton operates, as well as the colleagues in the shared service centre. And when we look at the structure, you'll see you don't actually sit within the shared service centre, but you are clearly liaising with them a lot. Okay, so a bit of background then. The Norton Group was established in Europe in the early part of the 20th century. It grew rapidly. So when we think about our life cycle costing, when we think about where we are, okay, and what experience we've got, we have got experience of rapid growth. And eventually we were a major force in the exploration and exploitation of the oil reserves in the North Sea. It expanded to other regions through a combination of acquisition and organic growth. So from an F2 point of view, again, if we think about acquisitions, we have experience of that. The Norton Group is a vertically integrated business, okay? And, you look at that in quite a bit of detail from an E2 point of view, don't you? It extracts, refines and sells oil, natural gas and petrochemicals. It operates in 85 countries and produces 2.8 million barrels of oil every day and has 41,000 petrol stations worldwide. The Norton Group's operations include exploring for oil in various countries, extracting, refining crude oil, manufacturing, selling petrochemicals, and the operation of petrol stations that retail fuel along with confectionery and newspapers directly to consumers. Wow, just take a moment to think about that, guys, in terms of what we do, and not just what we do as a company, but what that means from a syllabus point of view. Okay, first of all, we are a manufacturing organisation, but we also have a service element, don't we? From a service point of view, we've got the service that we're providing at the fuel stations and also the service that we're providing under the shared service side of things. Okay, as well as exploring. So from an exploration point of view, lots of R&D going in there as well. So there's so many things that we do. You could really just start to go crazy on the P2 syllabus and say, okay, then where is all this relevant? First of all, you could think about, what could we think about? Life cycle costing, first of all, to think about where we are in terms of the different products that we have. So some of our products are going to be in very, very early stages in the research, the exploration. Other areas are very much in their maturity, with the 41,000 petrol stations simply serving the fuel that we're producing. In terms of value analysis, it is important that we're able to establish the value that is required by the customer. And in a lot of ways, that's very simplistic. It's about getting the fuel into whatever it is that we need it to power. But along the way, we are going to have lots of other areas of interest that may be perceived as adding value in terms of maybe how we treat the environment, how we go about our functions and our operations. In terms of what we do, exploring for oil, extracting oil, even, you know, just operating a service station, there are lots of risks involved in what we do, and I mean physical risk, but obviously we have lots of other risks that we could establish as a business. For example, we operate globally, you know, so you have things like foreign exchange risk. You've got the risk of the business, you know, what if all of a sudden there is no more oil? You've got risk of sustainability there, haven't you? You know, and obviously that's a very big factor. So lots of different risks there involved in what we're doing. In terms of divisionalisation, responsibility areas, that's going to be very key, isn't it? Because we clearly have lots of different areas and functions of the business. Okay, so when we think about the performance management of each of these, it has a potential to be quite different in each of the areas. You might also then want to think a bit deeper into the performance management, where you think about how you would maybe benchmark yourselves in the industry and also division to division. Maybe things like the balanced scorecard. You know, the balanced scorecard, is that something that you think would be a useful measure? You know, should we be looking at lots of non-financial CSFs and KPIs? I would imagine that they will be relevant. Also, if we think about the fact that we have different functions serving each other, transfer pricing therefore seems extremely relevant. Okay, so it seems as though we're going to have some transfer pricing issues. And also then when we think about the information, the apparatus that's used in terms of oil exploration, oil extraction, the manufacturing, we've got 41,000 petrol stations. Does this go up or down? So I would imagine then that we have quite a lot of experience with investment appraisal, a big area of your P2 syllabus. Okay, what about replacing, you know, the cycle on which we replace some of our assets? So already you can see lots of the P2 syllabus from that one paragraph, very, very relevant, and they're the kind of things that we need to make sure that we are happy with. We're told that Norton Group comprises the parent company along with more than 200 wholly owned subsidiaries. Wow, so lots of subsidiaries. Again, from an F2 point of view, we're going to consider that. But also from a P2 point of view, again, you know, we need to think about how we're measuring the performances of each of those. Each of the subsidiaries falls into one of four categories. So it will either be exploration, extraction, refining, or petrol station. So again, thinking about divisionalisation, thinking about performance management. Each of these categories is under the control of a senior management team, and the four senior management teams report into Norton's head office. So as we say, we can think very much about the performance measurement there, guys. So already lots for you to be thinking about from a P2 point of view. Now we get into the shared service side of things. And so we switch now to thinking about the shared service centre. So we've just looked at the different kinds of services that we have with exploration, extraction, refining, and the actual fuel stations. But then the focus very much shifts here to the shared service centre. So Norton began to outsource its main record-keeping functions in the mid-90s, which involved batching all documents received or created by operating units and forwarding them to an independent company that provided data input, data processing. The company used these documents to update Norton's records, and the logic for this was partly to reduce admin costs, because centralising record keeping created efficiencies. For example, we did not need to maintain separate accounts payable department in each subsidiary, with each one needing supervision, training, office space, etc. With outsourcing then, it also permitted the operating units to concentrate on more fully on the core business activities. So what we see here then are the advantages here of outsourcing. And you will have very much looked at this when considering your P1 paper, your E1 paper, and also your operational case study. So that dealt with the outsourcing and why we would do it. The logistics of transferring the vast numbers of documents were complex, and Norton had concerns about relying on a third party to maintain records for critical areas such as accounts receivable and payroll. And also improvements in IT meant that it was becoming easier and more cost effective for large groups to create their own in-house shared service centre. So what we see here actually are the disadvantages of outsourcing, and therefore they made a decision to actually bring it back in-house, but not just to bring it back in-house and do it ourselves, but to create a shared service centre. Okay, so in 2002, the FOCCS was created. Technology was one of the key drivers in the decision. It had become viable for operating units to scan documents and transmit the resulting images to the shared service centre, which reduced transport costs and simplified the processing of assuring that all documents had been received and processes. So for me, I think that we're looking at shared service centres as being... as having its own areas for measurement of performance. Okay, so when we think about key performance indicators or critical success factors, we can see that one of the reasons for bringing it in-house was to ensure that these areas here were achieved. And so we need to ensure that we are reviewing to see if that's been achieved. Also then, there's been a shift away from paper documents since Shared Service Centre was first established, and most sales and transactions are now electronic invoicing, with copies of electronic sales and purchase invoices being forwarded straight to the Shared Service Centre as electronic files. Also, the petrol stations are equipped with state-of-the-art electronic point-of-sale systems in place of conventional tills, and these transmit information about sales transaction to FOCC in real time, with all sales being analysed by the FOCCS's Enterprise Resource Planning System. Apart from analysing sales, the system tracks inventory at each petrol station and manages credit card billing. So what we've got here then, we're managing the inventory, so we're probably operating a just-in-time inventory system there, but also then we are dealing here with information systems, which sits on your P2 syllabus, and also big data in the analysis that we're looking after. Norton Shared Service Centre is flexible and responsive, so that's one of the beauties, isn't it, of having that shared service centre, is that we are giving ourselves that flexibility and responsive. Again, you know, I think that's one of the key points that we need to measure its success on. It uses software that permits senior managers to submit complex queries, most of which can be answered with a tailored report quickly and at little cost. Okay, so again, at what speed are we resolving those issues? So again, from a performance management point of view, I would be picking out those areas. In addition to processing data, the Shared Service Centre collates budgets across operating units and consolidates them into a master budget. So thinking from then a budgeting point of view, and we know budgeting sits on our P1 syllabus and our P2 syllabus, we can see that the Shared Service Centre has the ability to pull that together. The system also automatically generates routine reports for budgetary control, with any significant deviations highlighted for further considerations. What is classed as a significant deviation? Okay, what are the parameters for this? Also then, the FOCC processes all banking activities and also payrolls and revenue. Managing all these different areas of a multinational organisation means that there are very strict processes and timescales which have to be followed. Okay, so again, we can see whether or not we are performing in line here, and also whether or not processes, etc., are up to date. Any deviation from the process causes widespread disruption. Okay, so this is a key risk area, isn't there? If we deviate, then we're going to cause a whole host of problems. The shared service centre operates as a cost centre, and the entire cost is charged to the parent company. The parent deals with subsequent charges to operating units. Okay, so thinking here then about our activities and also about our performance measurement. Okay, so we're charging those costs into the other units. What is the basis for this? What is the basis for those charges happening? Is it a relevant basis? Should we look at activity-based costing? Is that going to be more appropriate to share these costs out? Also then, if it's not a profit centre, how does this affect motivation? Okay, and again, how are we reviewing performance? So if we review performance on other areas in terms of profit, we can't do that for this particular service centre manager. Okay, so a bit more then about the structure here, and this is really interesting. So we've got Norton Group head office, and then you can see that we have the shared service centre sitting down here and being charged straight into that parent company. However, we also then have our exploration business unit, extraction, refining and petrol stations, and then we've got the operating units underneath them. So from a performance management point of view, these costs here, these are just costs. This is a cost centre. These costs are just getting charged into the head office, and the head office then decides how to share it out. Okay, so I would really like to see these costs going in to our operating unit so that we get true value down there. We are then told that each subsidiary is a separate operating unit within Norton corporate structure. The FOSSC works with the management teams of both the business units and the operating units to ensure that files and reports are structured in a manner that meets the management need. Okay, so that's important in terms of adding value, isn't it? And making sure that we are addressing their needs, not our own. The operating units are generally investment centres, and most operating units can be broken down into individual cost and profit centres. For example, petrol stations includes 65 operating units with an average of 30 petrol stations under its control. Each petrol station or filling station is a profit centre with performance data available from the shared service centre to enable operating units to study the performance of the unit or as a whole or by individual profit centre. So we can see then that the operating units will be an investment centre, they could be a profit centre and a cost centre. Okay, but we will get the information in that allows us to analyse it. It is important then that we have appropriate analysis in place for these. Remember, if we're an investment centre, we might want to look at things like our economic value added, return on investment and residual income as part of our performance review. Okay, we've then got a bit more information about this structure. So we can see that Norton is committed to growth, which puts its shared service centre under pressure both in terms of keeping pace with the increasing volume of transactions and the need to furnish the parent company's board members with reports and analysis that they require to manage such a complex entity. Each operating unit has its own budgetary control system, and one of the shared services functions is to aggregate and consolidate budgetary reports to enable senior management to understand how Norton is progressing. Each individual operating group is incorporated as a subsidiary company within the Norton Group, and the Shared Service Centre can compile performance statement for each operating unit and also aggregated statements that combine records geographically, by line of business, or in accordance with more specific requests. Okay, so in terms of how we are viewing the segments of the business, we get to do that however we want, really. So we can kind of break things down how we want them to be. And we can see here, look, we've got operating units by geography there. So we've got operating unit petrol 2, operating unit petrol 1, operating unit petrol 65, and then within that operating unit of petrol 2 for Western Centaria, we will then have 20 more petrol stations. Okay, so there is a lot of management levels there, isn't there? Lots of potential people who want reports. But also, when we're thinking about how we're going to review everyone's performance, we need to ensure we pick a fair and appropriate method. Okay, so looking then at the shared services processes, and as we can see, we've got a lot of information about the shared services. We don't really have a lot of information here about extraction, about the fuel stations, about the manufacturing, but it doesn't mean that it's not going to be there. But we do have a lot here about the shared service centre. So we do need to assume that most of the variants will be based on this, okay, but we can't ignore the other areas. So many of the processes for which the shared service centre is responsible are routine and repetitive. What does that start to scream out, guys? Starts to make me think about learning curve, which sits lovely on the P2 syllabus. Make sure you've got it back in your knowledge bank for recall. For example, the process of managing payables can be summarised as follows. So we've only got a payables section here. Okay, so you can go through the process then. So we have the invoice received as a paper document or file. We scan it, and these are read using technology. They're matched to the purchase order and goods received records, and any discrepancies are investigated. We find out later that discrepancies are done from a human point of view. So that happens at the operating unit, and at this point then we transfer it over to the shared service centre, who checks for any duplicates. They then get a final check against purchase order and goods received. So there's an element of duplication there, isn't there, really? And then the supplier's account is checked for validity. So obviously that is to check against fraud. So therefore that is a risk factor that's being mitigated, and then we record it in the purchase ledger, and the invoice is paid by the bank when it's deemed appropriate according to the credit terms. Okay. The system is designed to simplify the process while enabling shared services to carry out as much of the work as possible. The operating units conduct the initial checking of the payables to find anything that's correct or invalid. And then that should be eliminated before it goes to the shared service centre. But the shared service centre will then ensure that only valid transactions are being posted. Most processes are electronic. Human intervention are located where they can be managed most effectively, i.e. when we're looking at anomalies. Maintaining the purchase ledger at the shared service centre minimises duplication and simplifies information processing. For example, the shared service centre can provide Norton's Treasury with detailed day-by-day projections of payment to suppliers, which assists in managing the cash flow. So again, this is all part of your risk management. The shared service centre recruited 1,000 staff when it was first established, and it's now got new functions and has grown as we've expanded, and now have got 3,000 people. Okay, so again, you know, you could consider the risks around all of those people, so we need to make sure that they are all appropriately trained and following the relevant processes. The Shared Service Centre employs mainly unskilled workers for basic data entry work. Over time, improvements in IT have led to increased automation, and so the number of data entry staff has declined, and new appointments now need degrees, professional qualifications, language skills, etc. So we should actually see a shift in the cost. And again, we need to understand probably the activities that are going on to be able to absorb into the units. Okay. The Shared Service Centre makes extensive use of balanced scorecard to track the performance of the various sections, and this is a brief extract. So balanced scorecard, we've already touched on. Balanced scorecard examined a lot in your case. I can't recall that we've ever been given one before in the pre-scene though, guys, so this is something that's quite new, but it may be that we've got to analyse that in a lot of detail, or maybe suggest a new balanced scorecard for a different function within the business. So let's have a look at this balanced scorecard. This is looking only at the learning and growth element. Okay, so remember we have our 4 perspectives: financial, internal, customer and internal learning, innovation, learning and growth. So we're looking here at innovation, learning and growth. We're looking at staff recruitment and development, and this is about ensuring that all staff are suitably trained. Okay, so this is your critical success factor to ensure everyone's trained. The indicator then is every section head to submit a detailed training plan. So this is how we are going to measure it. This is your key performance indicator, and then this is it being actually measured. So every section head to submit a detailed training plan. 90% have. Okay, 90% projected. The target was 100%. So we're still in green here. So we had a target of 100%. So why are we green if we haven't actually achieved the target? I'm not sure. Okay, so not achieved, but it's showing as green, and that would mean that it's okay. So we've got a target, but we obviously have acceptable levels, so we need to understand what they are. Comment: the new head of payroll is still working on the plan. Then every newly appointed staff member is to receive a formal induction within 10 days. Again, we've got a target of 100%. However, we only achieved 72%. Okay, so clearly lower than acceptable. Do we therefore have some risks given the fact that this training hasn't happened? Then we have the training needs associated with every job title to be evaluated and documented. You know, we're very low at 66%. So again, this has got to be a risk to the business. We are told that section heads often prefer to provide their own induction training. So this is clearly against the policy. So we need to identify what the real policy is. And then we're told that the section heads often disagree over training. So here we've got a bit of conflict. You know, we need to consider goal congruence here. We're also told then that we need to recruit a highly trained, qualified staff. The proportion of new hires holding a degree with a target of 80%. Again, this hasn't happened, so this is a risk to the business, isn't it? We need to understand what we're doing about that. The programming section due to expand in May of this year. So hopefully that will create new possibilities for these recruitments to take place. Okay, you can see then that we've got the key here for what the metrics are. Okay, so they've rated it there, but you know, whether they're appropriate or not is for us to maybe discuss in further detail. We then have a vision, mission statement and strategy. So when we think about the balanced scorecard or benchmarking, any kind of objectives, anything we do, we should be linked to our values and our mission. Okay, so what do we want to do? We want to be recognised as world-class shared service centre. Okay, so here this is one of our KPI critical, well, it's critical success factor, isn't it? So we'd need to come up with a measure which we will achieve through the excellence of our people, services and processes. Okay, so again, these all link in to being our objectives. The mission is to support Norton by being value-added business partners to our internal customers. So again, how are we measuring whether or not we are achieving that? We're told that the shared service will enhance the internal customer's performance by analysing data with a view to identifying opportunities to increase revenues and or reduce costs. We're told that we will strive to make all interactions with internal customers as effortless as possible, and that includes simplifying any changes or transitions. And also we will provide a reliable and efficient services as internal customers, tasks are completed on time and costs kept under control. So again, all of these need to be measured, okay? They need measuring because these are objectives, okay? Insight, simplification and reliability. So they've given you a real good structure there if we were to talk in more detail about how we can pull together good performance evaluation. The strategy then is to meet challenging goals by engaging the best people who believe that there is always a better way. We will seek to understand Norton's evolving needs through our commitment to quality and excellence. So here we're thinking about total quality management as well as part of our strategy. The Shared Service Centre extends its business by developing as Norton expands and invest in the most advanced software and most efficient people. Okay, so it's very clear about what the Shared Service Centre is trying to achieve. The core values then are about listening, learning, working together, accepting responsibility and innovating. So again, we need to ensure that we can identify relevant KPIs for all of these. And again, lots of these things you are going to cover off as well from an E2 point of view. Okay, so then we get some budgeted annual operating costs. And from what I can make of this, this is from your shared service centre. So we're told that it's broken down section by section. So for me then, these are the different sections within your shared service centre. So we have our project management, management information and budgeting, receivables and invoicing, payables expenditure and payroll. They're the different functions within our shared services, and we can see them from a cost point of view, they're actually all pretty similar, aren't they, from a cost point of view. And then we've got information on professional staff, support staff, input IT, heat, light and power, other expenses, depreciation, amortization. So it would be interesting to see what percentages here are of our professional staff, support staff, etc. So if it were me, I'd like you to be doing an analysis on what those costs look like. Why? So that we know where to focus our attention when we start to think about cost control, and also when we start to think about activities, if we would start dabbling in activity-based management, activity-based costing, for example. Okay. We then have a lot of information about the management team. To be honest, this is going to be picked up really from an E2 point of view. But again, look, it focuses on the shared service centre. So a lot of our liaisons are going to be probably with Aldo Hirsch, who's the head of finance. Remember, we don't report strictly into him, but we are liaising a lot with the shared service centre. And it seems then that he would probably be the one. But also, we've got our other finance team here also going to be very, very relevant, okay, because these are all the department's heads within the shared service centre. The 5 section heads are responsible for oversight and management of the services provided, and we can see then that we've got a little organisation structure that sits into the shared service centre. Okay. Now, interestingly, we then get the financial statements. This is very common. We always get financial statements in our case study. But where we've now had pages and pages of focus on the shared services, we now get the financial statements for Norton as a whole. So this is all of the whole group, the subsidiaries, etc. So that's very interesting, isn't it, that we see, this is why we can't assume that we aren't going to have variants that deal with extraction, manufacturing and the petrol stations, because we are getting a mix of information from CIMA. So your wonderful F2 tutor will go through this in an inordinate amount of detail for you. For me, I'd probably like you to be focusing on things like your net profit margin, gross profit margin. You can have a look at, the general growth side of things. So looking at revenue, looking at profit, how much have we moved? Okay, we can see that we've definitely grown in the year. The operating profit, though, has gone down, which is very worrying. And the profit after tax has gone down, as has the profit before tax. But we had that increase in sales revenue. So revenue's up, but profits are down. Okay, that doesn't make for a happy accountant at all. So you're going to have a look at that into a lot more detail. We've obviously got a little bit going on there that concerns us, particularly the cost of sales has increased massively. Why has that happened? Okay. Now, obviously, we didn't have a bigger profit as we had before in terms of disposal of exploration and evaluation assets. There's a million difference there. So that's going to be a key figure in the differences. But even so, this cost of sales here, rather worrying as to how much it's gone up based on how much the revenue's gone up. Why haven't we got any economies of scale there? Are they all variable? I don't know if that's the case. But as we say, we've got this profit on disposal being a lot lower. Is that something that we forecast for, or was that unexpected? You've then got your statement of financial position. So again, lots of analysis to be done on there and things to be thinking about. Obviously, we can have a look from a liquidity point of view. Inventories have gone up. Trade and other receivables have gone up. Cash and cash equivalents has gone up massively. So we're obviously a lot more liquid from a cash point of view. What do our payables look like? They've moved, but only marginally. Okay, so I don't think from a liquidity point of view we're in too much of a bother given the increase in cash and cash equivalents. But again, if you want to do those ratios, it will give you more of an idea. It's also a good recap for you as well, isn't it, guys? Then we've got some segmental analysis. The segmental analysis is interesting. It's something that we do see a lot in case, but again, it's from Norton's financial statements. It's not something that's within shared services. It gives you an idea of the geography around our revenue and our profits. Okay, so we can see that we have Asia, who became our biggest revenue generator in 2017. This was a huge increase. Okay, and we all see a huge loss in the Middle East side of things. Okay, so why have we had this huge shift? We need to get some more info on why this has happened. So in terms of profit, we've seen a huge decline in Middle East, which, we would expect because we saw things go down. We have seen a profit go up in Asia. It has increased, but not by much considering the revenue increase. So is this where our cost of sales is out of control within the Asia area? And then we've got some segment assets. So you can see that we've obviously invested in the South Atlantic. So are we expecting some increase in revenue there? Okay, so that seems to be where we've made the most significant investment. We've then got a bit more information in terms of exploration and evaluation assets. So really, I'm going to leave this to your F2 tutor. It's not something that I'm really going to be too interested in. And then we come to the final section of your pre-scene analysis, which is always your articles. So first of all, we see the Accountant's Bugle interview with Amber Lees explaining what has changed at Norton's shared service. I actually really like this. I think it's really good. It gives us a lot more insight into our shared services. Okay, it's obviously demonstrating how amazing we've been, and this is all part of our bid to be world class in terms of the excellence of our shared service industry. It gives you the history. It tells us how we actually moved into being a shared service centre, you know, the fact that we expanded in terms of our employees. Also then different accounting being done, such as human resources, giving way to the fact that most of our staff will be qualified. Also service level agreements being asked about, and again that's something that we might want to discuss. And here, look, I was surprised that the whole cost of the shared service centre is transferred as a head office cost. Yes, some shared service centres add profit to their company, but we are just a cost centre and we strive to cut costs and seek continuous improvement and efficiency. So again here, look, it's giving KPIs, you know, it's giving examples of how we measure that performance, but also the question mark about what happens in the future. Are we going to stay as a cost centre? Is this the right kind of performance evaluation? Again, we've got about saving money. So again, this makes it an easy measure in terms of its success. Talks about the fact that lots of people are now doing shared services, and also focuses on our information system, and then obviously working into big data potentially as well. So I think that's a lovely article for you guys to really read and digest. Then we're told oil company shared jobs. So admin staff at the former oil refinery have been warned to expect significant redundancies. So you need to think about redundancies, obviously from an F2 and an E2 point of view, in the aftermath of a recent acquisition by ourselves. The newly appointed management team have announced that the jobs of the production staff were safe and that Norton planned to invest in increased capacity. However, it was confirmed that most of the administrative and record-keeping functions would be transferred to our shared service centre. A spokesman confirmed that at least 300 jobs would be lost, but that we would make every effort. So, you know, this really is very good for our reputation. Not really sure about that. And then finally, Norton Shared Service Centre upgrades to Amiga UPS. We became the latest major customer for the technology of Amiga in terms of the uninterruptible power systems. In the event of electrical power outage, the new system has the capacity to maintain operations without loss of data for 60 minutes. Okay, and we already know then that this is part of the risk, isn't it, of things going wrong being managed. Okay, and we can talk about risk management in a lot more detail when we are together. Okay guys, so that is your overview of Norton from a P2 point of view. So I'm hoping that that's given you a bit of scope for some of the areas that we might want to be dusting off in terms of our knowledge bank. I very much look forward to seeing you on the course. And if you have any questions or queries in the meantime, please let me know. For now, guys, well done.